Picture this, you get a call from your financial advisor, a man you've trusted for over a decade, a man your father trusted before you, a man your neighbors, your friends, your entire social circle have trusted for years. He manages the retirement accounts of doctors, charities, Holocaust survivors, university endowment funds. His track record is so consistent, so impossibly steady, positive returns every single year, through recessions, through market crashes, through everything that other advisors whisper his name the way people whisper about legends. You're not just a client, you feel like you're in an exclusive club. You sleep well at night knowing your life savings are in his hands. And then one December morning you wake up and turn on the news and you see his face. And you learn that the man you trusted, the man the entire financial establishment trusted, had not made a single legitimate trade in over 17 years. That every statement you ever received was fiction. That your money and the money of 37,000 other people across the world simply does not exist anymore. Bernie Madoff, $65 billion, the largest financial fraud in human history, and the terrifying part, it could happen again. In fact, in 2024, it almost did. My name is Lukazo, and I spend way too much time thinking about money, financial fraud, and the specific psychological mechanisms that allow con artists to steal billions from intelligent, careful people who should have known better. If you want to understand the real mechanics behind the largest scams in history, not just the headline, but the actual how and why, hit that subscribe button and give this video a thumbs up if it changes the way you see financial trust. Quick disclaimer, nothing here is financial advice. This is purely educational. Alright, let's go back to where it all started. Here's a number that should stop you cold. $65 billion. That is the total amount listed on client statements when Bernie Madoff's firm collapsed in December 2008. Not $65 billion in bad investments that lost value. Not $65 billion in risky bets that went wrong. $65 billion of money that clients believed they had money that appeared on official statements, generated tax documents, funded retirements, endowed charities that simply did not exist, had never existed, was never invested anywhere. The actual cash that came in from real investors over the decades was estimated at approximately $17 billion. The rest, nearly $50 billion, was fictional profit, fabricated returns. Numbers on paper generated by a back-office operation that had nothing to do with financial markets and everything to do with very good printers and a staff sworn to secrecy. To put the scale in human terms, Madoff's victims included Elie Wiesel's Foundation for Holocaust Survivors, which lost $15, $2 million. Yeshiva University lost $14, $5 million. The town of Fairfield, Connecticut lost pension funds. Steven Spielberg's charitable foundation was affected. Thousands of retirees across Europe, Latin America, and the United States lost everything they had saved over a lifetime. The average victim was not a reckless speculator. The average victim was someone who had done everything right, saved carefully, trusted credible institutions, and placed their money with a man who had served as chairman of NASDAQ and was widely regarded as one of the most trustworthy figures in American finance. So the question that matters, the question worth spending real time on, is not what Madoff did, it's how. Let's break down the actual mechanics of a Ponzi scheme, because understanding the structure is the only way to recognize one before it's too late. A Ponzi scheme has one fundamental operating principle. Returns paid to existing investors do not come from legitimate investment activity. They come from the deposits of new investors. The system functions exactly like a chain. As long as new money keeps flowing in faster than old money flows out, the fiction holds. The moment redemptions outpace new deposits, the entire structure collapses simultaneously and completely. Think of it like this. Imagine a restaurant that has never actually cooked a single meal. Instead, every time a customer orders food, the waiter goes outside, buys a takeout container from the place down the street, plates it, and serves it as if it came from the kitchen. As long as the restaurant keeps getting new customers and the profit from their orders covers the cost of the takeout, plus enough left over to pay the staff, the operation continues. The moment the restaurant gets more orders than it can afford to fill, the whole thing collapses. And when it does, every customer who thought they were eating house cooking discovers there is no kitchen. That was Madoff's operation. For 17 years, from approximately 1991 until his arrest in December 2008, his investment advisory business at Bernard L. Madoff Investment Securities generated not a single legitimate trade. The supposed strategy, a sophisticated options overlay approach called a split-strike conversion, was explained in enough technical detail to satisfy the questions of most clients and several regulators. But the actual trading never happened. The returns, consistently 10 to 12% annually, through bull markets and bear markets alike, were fabricated. The account statements were generated by a separate floor of the building, staffed by a team who worked in deliberate isolation from the legitimate brokerage operation upstairs. What made Madoff uniquely dangerous was the specific architecture of trust he constructed. He did not advertise. He did not pursue clients aggressively. He created exclusivity. Access to his fund came by personal referral only, and he frequently turned people away or made them wait. The The psychological effect of exclusivity is profound. We trust things more when we perceive them as difficult to access. We assume that if something is hard to get into, it must be worth getting into. Madoff manufactured scarcity as a credibility signal, and the financial establishment fell for it completely. He also kept returns deliberately modest. Other fraud schemes promise extraordinary gains, 50%, 100% guaranteed. Madoff promised 10 to 12% annually. Steady, consistent, boring. And in financial markets, boring consistency is genuinely the gold standard because real markets are volatile, and consistent non-volatile returns over time are actually the #1 red flag for fraud. Madoff's genius was understanding that modest reliability would attract exactly the type of sophisticated, conservative investor who would ask the fewest disruptive questions. Here's what most people completely miss when they study this case, and I'd argue it's more important than the fraud mechanics themselves. The question is not how Madoff fooled unsophisticated people. The question is how he fooled the SEC, institutional fund managers, and some of the sharpest financial minds in the world. The answer requires understanding two specific cognitive biases that operate powerfully in high-stakes financial environments. The first is what psychologists call affinity fraud dynamics, the outsized trust we place in people who belong to our social or professional group. A disproportionate number of Madoff's victims were members of Jewish country clubs, philanthropic circles, and tight-knit social communities where Madoff was a known, respected, deeply embedded figure. This is not coincidence, it's architecture. When someone you already trust introduces you to an investment, your brain processes that introduction as a pre-verification. You are not starting your trust assessment from zero. You are starting from the credibility of the person who referred you, which dramatically compresses your independent scrutiny. The second is authority paralysis, the specific reluctance to question someone who occupies a position of established institutional authority. Madoff had been chairman of NASDAQ. He sat on SEC advisory committees. He was not just a successful investor. He was a regulator-adjacent figure, someone whose professional identity was intertwined with the very systems designed to prevent fraud. Questioning him felt, to many people, like questioning the system itself, and that feeling was exactly the protection he relied on. Harry Markopolos, a financial analyst who figured out the fraud mathematically in 2000, submitted detailed evidence to the SEC 5 separate times over 8 years. He was ignored 5 times, not because the SEC lacked the information, because the authority gradient between a relatively unknown analyst and a former NASDAQ chairman made the accusation feel implausible at an institutional level, regardless of the math supporting it. The fraud did not survive because people were stupid. It survived because of very specific, very human psychological mechanisms that operate in all of us, including you, including me, when we're inside systems of established trust. Let me give you the data points that make this real. When Madoff confessed to his sons in December 2008, the same sons who then reported him to the FBI, the immediate trigger was the 2008 financial crisis. As markets collapsed, redemption requests from investors needing liquidity spiked simultaneously. Madoff needed approximately $7 billion to cover outstanding requests. He had $300 million available. The gap was unbridgeable. He confessed to his sons, was arrested the following morning, and sentenced in 2009 to 150 years in federal prison. He died in custody in April 2021. The recovery process through the Madoff Victim Fund ultimately recovered and distributed approximately $4 billion to victims, a fraction of the losses, spread across years of legal proceedings and clawback litigation that attempted to recover funds from investors who had withdrawn more than they originally deposited. Now here's why this matters in 2024. The Madoff pattern did not die with Madoff. In 2024, federal prosecutors and the SEC brought charges in multiple cases that followed the identical operational blueprint. One of the most significant involved a Texas-based investment firm that raised over $100 million from investors, predominantly members of tight-knit religious communities across the American South, by promising consistent double-digit annual returns through a supposedly proprietary real estate and commodity strategy. Like Madoff, the strategy was never executed. Like Madoff, returns to early investors were funded by deposits from later investors. Like Madoff, the scheme operated for years because it was embedded in a community of high-trust relationships where questioning the operator felt socially costly. Separately, in 2024, the FBI's Financial Crimes Unit reported a significant increase in what investigators classify as affinity fraud, Ponzi-style schemes, specifically targeting defined community groups, religious congregations, and immigrant populations where social trust creates natural barriers to skepticism. Total losses from affinity fraud in the United States exceeded $3 billion annually, according to 2024 enforcement data, and that figure represents only schemes that were detected, prosecuted, and reported. The actual number is almost certainly higher. The through line between 1991 and 2024 is identical. exclusivity, consistency, social embeddedness, and the deliberate cultivation of an environment where asking hard questions feels like a social transgression rather than a reasonable precaution. So what do you actually do with all of this? First, understand the specific red flags that apply universally, not just to crypto, not just to Madoff-style schemes, but to any investment you're evaluating. Consistent non-volatile returns over multiple years is a red flag, not a feature. Real investments fluctuate. If someone shows you a track record of steady positive returns through market downturns, bear markets, and economic crises, your response should not be admiration. It should be how. Demand a specific, verifiable answer, not an explanation of a strategy, an explanation of where the actual returns are custodied and independently verified. Second, who holds your assets? This is the single most important question in personal investing. Your money should be held by a third-party custodian, an institution entirely separate from the person managing your investments. Madoff was both investment manager and custodian, which meant he controlled both the trades and the statements. That structure should never exist. Ask who the custodian is before you invest anything. Third, independent auditors matter. Madoff's operation used a tiny one-person accounting firm to audit a multi-billion-dollar fund. That is a concrete, verifiable red flag. Ask who audits the fund. Research that firm. A legitimate operation of any size uses a recognized, reputable auditor whose own credibility is on the line. But here's where most people mess this up after they hear about Madoff, and I see this response constantly. They immediately assume Ponzi schemes are easy to spot. They think, that's obviously a scam, I would never fall for that. And that confidence, that comfortable certainty that fraud only happens to other people, is precisely the psychological state that makes someone most vulnerable to the next version of it. The people who lost money to Madoff were not naive. They were not financially illiterate. Many of them were attorneys, accountants, former finance professionals, people who had spent their careers evaluating risk. They were fooled not because they lacked intelligence, but because they operated inside a system of social trust that made skepticism feel unnecessary and socially inappropriate. The correct response to learning about Madoff is not confidence that you would have caught it. The correct response is to build specific, mechanical verification habits, questions you ask before every investment, every time, regardless of who's in the room and how credible they seem. Because the credibility is exactly what the fraud is designed to project. 17 years, $65 billion, 37,000 victims across the world, and a confession that came not because someone finally caught the fraud, but because a financial crisis forced a moment of liquidity that the fiction could no longer survive. Madoff didn't run the largest fraud in history because he was uniquely evil. He ran it for 17 years because he understood, better than almost anyone, how trust works in financial systems and how to manufacture it. And the people who protect themselves from the next version of this story are not the ones who believe they are too smart to be fooled. They are the type of people who build the habit of verification, who ask hard questions in rooms where hard questions feel uncomfortable, and who understand that the strength of a recommendation from someone you respect is not a substitute for independently understanding what you are actually putting your money into. That habit is worth building, and it starts now. If this gave you a different framework for thinking about financial fraud, hit the like button and subscribe. We break down stories like this every single week. And if you want to know the specific questions to ask before trusting any financial advisor with your money, that's exactly what the next video covers.